Hello and welcome to BYJU'S Exam Prep IAS. Welcome to another session of Indian Economy Essentials. And in today's session, let's try and understand what has exactly happened in one of the big banks in USA, that is Silicon Valley Bank. In short, SVB. What has happened there? And what are the important concepts that are relevant for exams? How should you understand this crisis? Let's understand this. Now, before understanding what exactly has happened in the SVB, you should be very careful, you should be mindful about three very important concepts here. What are these? One, concept of a connection between interest rates and bonds. Second one is asset liability mismatch, in short ALM. And the third one is the idea of a bank run. Let's start now. Interest rates and bonds. Now the term interest rate generally represents what is the rate of interest that is applicable on lending and borrowing. For example, let's take India. RBI will provide loans to banks, and banks in turn will provide loans to borrowers. The borrower could be you, borrower could be me. Now why this sequence is important? Whenever RBI wants to promote growth, RBI will reduce interest rates. When RBI will reduce interest rate, banks are taking loans at a lower rate of interest and they are giving loans at a lower rate of interest to borrowers. What is the objective here? Loans, whenever these are available at lower rate of interest, people will take more loans. Companies will take more loans. Demand is going to increase. Investment is going to increase, which is going to promote recovery in the economy. But on the other hand, if the central banker, rather than promoting growth, now wants to control inflation, and they do that, by the way. If they want to control inflation, what they do is they will increase interest rates. They'll simply increase interest rates. And when the central banker will increase the interest rates, banks in turn will also transfer this higher rate of interest to the borrowers or customers in the market. The objective here is very simple. The central banker wants to reduce the amount of money supply in the economy, wants to control inflation. Now just apply the same logic to the USA market. In USA, rather than RBI, we have Federal Reserve. Federal Reserve, that's a central bank. And the Federal Reserve, in the last couple of years, in order to promote recovery in the market, has reduced interest rates, technically referred as a Federal Funds Rate, FFR, Federal Funds Rate. And now, because the recovery is taking place, inflation is a bigger concern. Just like many other countries, the Federal Reserve has started increasing the interest rates. So that is the first point. Please remember this. Now, what is the connection? Why should you understand it? Imagine you are an investor. You are an investor. You have purchased one instrument which is offering, let's say, 8% interest. It is offering 8% interest. Now, this instrument in the market, whenever you want to sell or purchase, the market price of the instrument will keep on varying. I repeat, the market price of the instrument will keep on varying. For example, bond. Whether it is a corporate bond or the government bond, the market prices of these instruments will keep on varying. Now you will ask me, sir, why? Why is that the bond prices will vary? Reason is very simple. The changes in the supply and demand forces will have a huge impact on the market prices of the bonds. And one more very important point here is, whenever the interest rates in the market will change, automatically the market prices will get adjusted. Right? What is the meaning of it? Let's take a very simple example. Imagine here is a bank. This bank has purchased one bond, that is, let's say, government bond. And in case of India, government bonds are basically referred as dated securities. In fact, government securities are of two types. One is a dated security, second one is a treasury. Dated securities will have more than 1 year maturity period, and treasuries will have less than 1 year maturity period. In the same way, in case of USA, rather than dividing all of this, they'll simply refer to them as treasuries. that is government securities, are referred to as treasuries. Now imagine here is a bank which has invested and purchased government bonds. And when they purchase the government bond, the coupon rate, that is interest rate on a bond, let's say is 8%, and the bank paid 100 rupees or $100 on the bond. Now what I'm saying, in USA, in the last couple of months, in order to control inflation, the Federal Reserve has increased interest rates. Now, rather than 8% in the market, the interest rate, let's say, is 9%, let's say is 10%, etc. Imagine you want to purchase this bond. Simple. You want to purchase this bond. Even if you purchase the bond, you will get how much? 8% of $100, that is $8. You're simply going to get $8. That is the amount of coupon you're going to get. But your concern now is, why should you invest $100 and get $8, that is 8% returns, when in the market interest rates are above 8%? That is, let's say around 9%. When the interest rates, that is the yield that you are going to get in the market, is around 9%, why will you be happy with $8 on investing $100? Of course you will not be happy. As a result of this, what will happen now? Simple. You want to get 9% interest. You want to get 9% interest. As a result of this, now if I am the owner of this bond, I will sell it to you not at $100, rather, I'll just throw arbitrary number here. Don't say, sir, calculation is wrong, etc., etc. Don't worry about calculation. Rather than selling it at $100, now I will simply sell it at, let's say, $98. So you will purchase the bond at $98, and after 1 year, the government will pay you, let's say, $8 coupon. So your returns on the bond will be more than that, more than 8%, which was earlier given. This is basically referred to as yield. This is referred to as yield. So remember this very carefully. The market prices and the yield rate in the market are inversely related. Simple. The market prices of the bonds and the yield rate are inversely related. If the market prices will go up, yield rate will come down. If the market prices of the bonds will go down, yield rate automatically goes up. That is, let's say you are earning $8, but the market prices of the bonds will go down from $100 to $95. You are earning $8 by investing $95. That is, yield rate is much higher than 8%. But on the other hand, if the yield rate goes below, how is that possible? Simple, market prices will go up. From 95, imagine it will go to $105. So you will spend 105, that is pay 105, get $1, one bond, not dollar, one bond, and you will get $8 returns on it. So $8 divided by 105, your returns would be lower. Now some of you might be thinking, sir, why all of this is needed? Simple. The bank which has collected lot of deposits has invested, let's say, in government bonds. Understand this carefully. A bank has collected lot of deposits, has used the deposits to invest in government bonds. Now tell me, if interest rates in the market go up and the bank will sell the bond in the market, do you think the bank will get more money or lesser money? For example, a bank has invested, purchased a government bond, paying $100. Interest rate in the market has gone up. So obviously the bank will have to sell it at less than $100 in order to ensure that the buyer now will get interest rate or higher yield rate. Now please remember that that is a connection between interest rate and the bonds. There is a connection, and what has happened in the context of SVB you will understand in a couple of minutes. Second point, asset liability mismatch. ALM, asset liability mismatch. What is this asset liability mismatch? First and foremost, for a bank, assets are loans. Remember this. For bank, assets are loans or investments that they have done. Whereas the deposits are liabilities. Some of you will be confused. You will be confused because you are thinking like a customer, not like a bank. For a bank, they will collect deposits, but they will have to repay deposits, hence a liability. For a bank, they will give loans, they will earn interest on the loans and collect the principal back, hence the asset. But what is this asset liability mismatch? ALM, what is it? Whenever the bank will collect deposits, let's say the duration of the deposit is 3 years. I'll take a very simple example. A bank will collect a deposit. The duration means, imagine you have gone to a bank, you have kept a fixed deposit of 3 years. Whatever the amount is. Now the bank will take that money and give it in the form of a loan, but this loan, imagine it is a housing loan of a duration 15 years. Here itself, I hope you understand the problem now. That is, the liability of a bank has a maturity period of 3 years or has a tenure of 3 years, whereas the asset for the bank has a tenure of 15 years. This is referred to as asset liability mismatch. Now, what is the importance of studying asset liability mismatch? Do banks face asset liability mismatch? Of course, yes. And it's not just applicable to SVB, even the banks in India face asset liability mismatch. And the issue related to asset liability mismatch is, there are two types of risks. One is interest risk. First risk is interest risk and second one is liquidity risk. Now let me start with the latter one, liquidity risk. Whenever you come across the term liquidity in the context of a bank, it simply means how much money is available for the banks for lending purposes. I hope you understand. How much money is available for the banks for lending purposes. That is called as liquidity risk. Now why there is a liquidity risk here? Simple. You have given, let's say, 100 rupees to me for 3 years, and let's say all the 100 rupee, I will use it. I'm a bank. I will use it, give a loan to a businessman for 10 years. After 3 years, you will come to me, you want to withdraw the 100 rupee, but that 100 rupee is there with the businessman who is going to repay me in 10 years. Don't you think I will not have that money to repay to you? It doesn't mean that the bank will not repay. Bank will generally collect other deposits. Bank has other arrangements where they can collect the money and give the money back to you. But nevertheless, there is a risk. That is a liquidity risk. Second one is interest risk. What is this interest risk? Imagine you have kept the deposit with the bank, and right now the deposit rate, that is the rate of interest on the deposit, is 4%. Which means the 100 rupee, I will give you 4% interest rate. Now after 3 years you will come to me. I don't have the 100, I have given it to a businessman, I am yet to recollect it. I will collect a deposit from some other customer, 100, and give that 100 rupee to you. But here is the problem. What is the problem? When I collected the 100 rupees from you, what was the rate of interest? 4%. When I will collect the new deposit from another customer to pay you back, what if the rate of interest is 6%? I am paying higher interest rate now. So interest risk is there, as well as liquidity risk is associated with the concept called as asset liability mismatch. And even SVB has faced ALM. And the third point here is concept of bank run. The idea of bank run. Let me take a very simple example. Imagine two customers A and B will go to bank, deposit 100 and 200 rupees each. So the bank now has a total deposit of how much? 300. Assuming there are no absolute reserve requirements. What is the reserve requirement? In case of India, if a bank has collected deposits, they will have to maintain a reserve with RBI called as CRR, cash reserve ratio. Imagine there are no reserve requirements. So what the bank has done? It has used the 100 rupees to give loan in the market. Now, there is a news in the market. There is some news related to this bank in the market, and the news is not good. The news could be either bank is incurring a huge amount of a loss. The bank has given loan to a businessman has shut down the company. The bank's NPAs, non-performing assets, are very, very high. etc., etc., etc. In simple terms, unfavorable news regarding a bank. Now, when you see that there is an unfavorable news and it's a very dangerous news, very grave news, as a customer, what will you do? You will go to the bank and ask for withdrawal of 100, and we will also ask for withdrawal of 200. Now, when the customers continuously worried about the financial stability of the bank, will go to the bank and start withdrawing the money, the bank will very soon run out of the cash to pay them. Simple. The bank will exhaust all the cash they have to pay the amount back. This is referred to as a bank run. This situation is referred to as a bank run. Now, these are the three very important concepts. We'll connect all of them with Silicon Valley Bank and understand what has actually happened there. What is the impact of it? Let's start with a story here. Silicon Valley Bank is one of the major lenders for startups, especially software companies in California or the region around California in USA. Hence the name Silicon Valley Bank. Now, Silicon Valley Bank in the last couple of years, when the interest rates in the market were very, very low, collected huge amount of deposits. Collected lot of deposits from the customers. What is the value of deposits? Many newspapers, I'm pretty sure you have seen the data, more than, right, or let's say around $200 billion. Now, when you collect all of these deposits or you mobilize so much amount of deposits, what do? You will invest in the market. You will start giving loans and invest in the market. And one such investment that was done by SVB is they purchased a lot of bonds in the market. And in the last 2 years, like I already have mentioned, interest rates in USA were already low, which means the bonds were also offering lower interest rate. So they purchased a lot of these bonds and accumulated lot of these bonds, kept it with themselves and provided loans to many other software companies, startups, etc. Now, what has happened in recent times is the Federal Reserve in USA, just like RBI in India or European Central Bank in Britain, what they are doing is, in order to control inflation, they have started increasing interest rates. They have started increasing the interest rate, which means the bonds which are held by the bank, if they sell it in the market, if they basically sell it in the market, now they will not be able to sell it, let's say at $100 at which they have purchased, now they will have to sell it at lower price. Remember that. So the interest rates in USA have started increasing thanks to the tight monetary policy or tighter policy followed by the Federal Reserve. Point number one. Point number two, unlike earlier years, now the startups are finding it very difficult to raise funds in the market. I am pretty sure all of you have come across the terminology called as funding winter. Funding winter, that is in simple terms, the amount of capital that the startups are able to raise has automatically come down, and there is a reason for it. Reason is, whenever in the market interest rates will keep on increasing, it simply indicates that investors by investing money are taking a risk. And these kind of investors, when the interest rates are increasing, they would want to stay away from a higher risk. So the checks they are writing, in simple terms, the funding they are providing to the startups has dried out. Now here is a startup which has deposited a lot of money into SVB, and now they are finding it very difficult to raise the funds from the market. What do you think the startup will do? The startup has started withdrawing, started taking out the money from SVB. Now, when the companies which have deposited money, when they start withdrawing money, and there is a reason for that as well. Some of you might be saying, sir, why are the startups taking out the money? Reason is they will have to pay salaries. They will have to pay for marketing expenses, etc., etc., etc. So other sources of money, such as funding, has dried up. Now they need money. They are going to the SVB bank. They have started withdrawing money. Now, as a result of this, what is going to happen? The SVB has taken the money invested in the bonds, has given loans to others. Now when the depositors will go to the bank and start withdrawing the money, can the bank sit quietly? Of course no. It will start running out of cash. And when it will start running out of cash, what they've done is, they've taken these bonds, which were to the tune of around $21 billion, and they've sold in the market. Now when the interest rates are high, and you have purchased the bonds when the interest rates were low, the market prices at which you will sell the bonds would be lower. As a result of which, the bank has disclosed that they have sold the bonds, but they have incurred a loss because of that. Right? They purchased at, let's say, $100 and they sold it at, let's say, $95, which is nothing but the loss for the bank. So they reported saying that we have incurred a loss. So have a look at this. Interest rates has gone up. Yield rate in the market is higher. They have incurred a loss by selling the government bonds. And why they are selling the government bonds? Because they are facing the issue of asset liability mismatch. Now after this, what they have done is they have given a proposal. They have given a proposal where they are saying, we will sell the shares of the company and will be able to collect a lot of capital. Please do not worry. And all of this information, just to calm the investors, just to calm the depositors, the bank has conducted a meeting with all of them, has apprised all these depositors about what is happening. They have told, don't worry, this is exactly what has happened. We are taking steps and we are going to address it. Now, the moment depositors have come to know that there is a problem with the bank, what they have done is they have started running to the bank to withdraw the funds. In fact, to the many other companies or let's say financial institutions who are there in that meeting, they have told their customers, I hope you understand, many financial institutions which were there in the meeting, they have told their customers that the bank is under crisis. There is a problem with the bank, right? Safeguard your deposits. So there is a panic which has started. Customers, that is depositors, one after the other, have started withdrawing the funds from the SVB. And as a result of this, now the bank has faced a bank run crisis. And realizing that there is a crisis, there is going to be a problem in the bank, the regulator in U.S.A. has stopped transactions, has closed this bank. Right? These are the events, sequence of events that have taken place in the Silicon Valley Bank. Now, what are the repercussions of it? What is the impact of it? Point number one. Generally, many of the customers, many of the market participants now are concerned that this is basically going to be a repeat of 2008 global financial crisis. That is, in the year 2008 global financial crisis, the starting point of it was the crash of one of the banks in U.S.A. Now they fear that the same thing is going to happen. That is, Lehman Brothers event is going to happen all over again. But the fact of the matter is simple. If you look at this particular bank in terms of asset size, it's not a very, very large bank. It's not a very, very large bank. Yes, it is one of the important banks, regional banks, but it's not a very large bank which will have a huge spillover effect in the overall economy. That's point number one. Point number two, depositors in other banks now are concerned. It might actually lead to a stampede situation where whether the bank is doing well or not doesn't matter, because there's a panic in the market. Customers will go to the bank and start withdrawing the funds, and that is going to have a huge impact on the system. Third, many of the startups, including some from India, many of the startups have kept the deposits with this bank. Their accounts are there in this bank. Now there's a concern that their accounts might basically be frozen for a long duration, or they will not be able to get access to their funds for a long duration. But to be very clear here, there is a concept of insurance for the deposits. There is this idea of a insurance of the deposits. In India, we have insurance for the deposits. Even in USA, there is a federal institution which will provide the insurance to the deposits. In USA, the insurance that is provided is $2.5 lakh. $2.5 lakh. To that extent, the deposits are insured. But even many of the experts are saying, and many of the companies already have clarified that, Because they will receive this amount. Because they will receive this amount, they do not want to keep the amount in USA. Now they want to bring back this amount and they want to set up, right, basically these accounts in the gift city, that is in Gujarat. Right, so these are certain very important repercussions, or let's say the ripple effects of SVB crisis. Now, can the same event take place in India? Can the same thing happen in India? Absolutely no. Right, and when I say absolutely no, right, to a very great certainty. Right, because understand this, 100% guarantee is very difficult. But please understand, these kind of events earlier used to happen even in India. Earlier also used to happen in India. But now some of you will simply say, sir, you are wrong. Couple of years ago, there was a crisis of similar nature, not the same, similar nature in a cooperative bank. My dear, that's a precise reason why even now cooperative banks, urban cooperative banks specifically, have been brought under the regulation of Reserve Bank of India. Reserve Bank of India now has been given more powers in order to control how these urban cooperative banks or generally cooperative banks are going to function. And in case of India, if you see, even in the year 2008, when the global financial crisis happened, Indian economy was affected. No doubt, Indian economy was affected. But if you look at what kind of impact India experienced, to a very great extent, the impact was muted compared to the impact that was felt by European banks or European markets. And that's a precise reason. Now there's a concern that in the European markets, some of the banks would be affected by SVB crisis. Now, why do I say Indian banks are much protected and a much better level compared to other banks in other markets? Because of the proactiveness of Reserve Bank of India. In the sense, the guidelines are so stringent in India. The reserve requirements are so strict in India. For example, I'm pretty sure you've come across the term CRR, cash reserve ratio, statutory liquidity ratio. To what extent the bank is supposed to expose itself in the sense, to what extent they are allowed to give loans to startups. Some of these new companies, there are a lot of guidelines and regulations which have been imposed by Reserve Bank of India on these banks. And that is the precise reason I said a similar event in case of India is unlikely to happen thanks to the proactiveness of Reserve Bank of India. But having said so, if a particular bank, or let's say the officials in a particular bank with a malice, right, with let's say quid pro quo intent, if they do something, then basically we are coming to know about it only after the event has taken place, not before the event taking place. So these are certain very, very important points regarding the collapse of SVB, that is Silicon Valley Bank, one of the largest lenders in terms of silicon or the startup market in USA, and the impact of that in other countries. Having said so, I just want to add one more very important point here. Just like a bank deposit insurance provided in USA, we also have a bank deposit insurance even in India. Even in India, we have bank deposit insurance. That is, whenever you keep deposits in the bank, there is one authority, or let's say one subsidiary of Reserve Bank of India, which will provide the deposit insurance to these deposits. Now, I want you to answer what is the name of that authority in the comment section below. Okay, so these are certain very, very important points. Now, based on this discussion, I have one MCQ. The term bank run, often appearing in the newspaper, refers to what? The banks performing very well, leading to higher profits? No. Depositors continuously withdrawing the funds, worried about the stability of the bank? Yes. The bank expanding its network rapidly in the global market? No. So the right option to the question is option B here. That is, the depositors continuously will start withdrawing the funds, being worried about stability of the bank. So these are the various concepts I wanted to discuss regarding the SVB crisis. If you like these initiatives, please hit the like button. Provide your valuable comments in the section below. And if you yet to subscribe to BYJU'S Exam Prep IAS, kindly do it now. Thank you. Have a great day.